How can organizations effectively fund their operations and strategic initiatives? This video explores the various sources of finance available to organizations, both internal and external. Discover how these sources impact financial planning and strategic growth.
Retained earnings are profits kept in the company rather than paid out as dividends. These funds are reinvested into the organization for future projects. They provide a crucial source of finance without diluting ownership. However, their availability depends on past profitability. Efficient use of retained earnings reflects sound financial management. Effective working capital management involves handling inventory, receivables, and payables. It frees up cash for operational needs, ensuring liquidity. This process supports operational efficiency. Proper management is vital for maintaining a healthy cash flow. It reduces the need for external borrowing. Selling underutilized assets generates funds for the organization. This one-off source of finance can be significant depending on the asset's value and market demand. Asset sales can provide immediate liquidity. However, they may reduce future earning potential. Equity financing involves raising capital by selling shares. It is essential for startups lacking internal funding. This method attracts private investors or public markets. However, it results in ownership dilution. Equity financing supports significant capital expansion. Debt financing includes borrowing from banks or issuing bonds. It requires repayment with interest, affecting cash flow. Unlike equity, it doesn't dilute ownership. Debt is suitable for organizations needing large sums. However, it increases financial risk due to repayment obligations. Government grants offer funds without repayment obligations. They support specific industries or projects. These funds can be competitive and conditional. Grants align with government policies. They are attractive for organizations seeking non-repayable finance. Crowdfunding raises finance through platforms like Kickstarter. It involves soliciting small amounts from many people. This method is effective for community-engaged projects. Crowdfunding supports startups with innovative ideas. However, it requires substantial marketing efforts. Internal finance avoids ownership dilution and debt. It depends on profitability and operational efficiency. External finance offers significant sums but affects control. Equity financing dilutes ownership, while debt increases risk. Organizations must balance these sources for optimal strategy. Savings incur no interest and maintain control. They are limited by available funds and personal sacrifice. Reserves offer flexibility without repayment obligations. However, they may affect liquidity. Both sources are crucial for financial stability. Overdrafts provide flexible, quick access to funds. They come with high interest rates and repayment uncertainty. Loans offer large amounts with fixed schedules. They require interest payments and collateral. Both options are vital for short-term and significant investments. Mortgages offer long repayment periods with lower rates. They are secured against property, posing asset risks. Credit cards provide convenience for short-term needs. They have high interest rates and fees. Both options require careful financial planning. Trade credit improves cash flow without immediate payments. It is limited by supplier terms and can strain relationships. Venture capital provides funds and expertise but dilutes ownership. It demands high growth and returns. Both sources support business growth. They dilute ownership and require dividends. Crowdfunding offers market validation without debt. It involves public idea disclosure and marketing. Both options are suitable for raising substantial funds. Bond issues provide large, long-term capital. They involve fixed interest payments and legal obligations. Bonds retain ownership control. However, they add to the debt burden. This source is ideal for infrastructure projects. Personal savings offer full control but are limited. They are suitable for small projects. Retained profits avoid ownership dilution. They depend on company profitability. Both are strategic for initial funding and reinvestment. Bank loans provide capital for medium to long-term projects. They retain ownership but require collateral. Overdrafts offer flexible short-term funding. They come with higher interest rates. Both are strategic for cash flow management. Venture capital provides substantial funds and expertise. It dilutes ownership and expects high returns. Equity financing raises significant capital without repayment. It involves ownership dilution. Both support high-growth potential projects. Trade credit enhances cash flow with deferred payments. It depends on supplier relationships. Crowdfunding validates market interest without debt. It requires marketing and public idea sharing. Both are strategic for managing finances and engaging communities. Government grants offer non-repayable funds for specific projects. They are competitive and conditional. Bonds provide long-term capital with fixed payments. They retain ownership but increase debt. Both are strategic for funding large-scale initiatives. Internal sources offer control but limited funds. The strategic choice aligns with business goals. A balanced approach ensures financial stability.
In conclusion, this approach ensures sustainable growth and long-term operational success. Thank you for watching this video. If you have any questions, please feel free to contact us on WhatsApp at 0748 436 1688.